you'll see like a plateauing and actually decline in almost every single major industry except healthcare. In fact, like when we look at professional business services, like this is where all of like the legal, accounting, people that are working for tech companies, like all of like the white collar jobs, it is actually in decline right now. And it has never been in decline in the history of the data. And that data goes all the way back to the 1930s, outside of a recession. Out of like 128 million people base within that initial kind of native born group, we added 11 million jobs. It's not that many over 18 and a half years, right? Immigrants or foreign born, the base was like 23 million. They added almost 9 million jobs. So we would have been short 9 million jobs today had we basically shut the border. That's where all the growth in the US born population is coming from. It's coming from the 65 plus. In fact, when you look at the census data, they forecast that the 64 and younger native born is going to decline. It's going to be lower in 2100 than it is now.
Hi, Eric. Welcome to Excess Returns.
Hey, thanks for having me, guys.
At Bancreek Capital Advisors, what you're doing is building a data-driven investing firm that is applying the principles of information theory. And I think we'll get to what that is to uncover, signals that you're seeing in the market or in specific companies, and trying to, at least when you build portfolios, trying to find companies that have a structural advantage in their business over the long term. And we'll talk about your investment process here shortly. One of the other interesting things that you do on your website is you kind of open the door to this visualization process. And there's a couple tools and visualizations that are on the website. We're going to pull some of those into this discussion to try to give some context and some visuals to, what you guys are seeing in the underlying data. So we'll look at those things. We'll talk about inflation, the broader economy. We'll take a look at your investment process and talk through that. And also, and hopefully we have a chance to get to this, I think you're putting out a pretty interesting paper on immigration. I think this is coming out tomorrow that has some really, I think, important pieces of information that investors are going to want to pay attention to. So hopefully we have time to uncover all this stuff. So really appreciate you joining us. I'm joined today with Matt Ziegler from Some Point Investments to help with this. Kind of do some heavy lifting for me, Matt, here, some of these topics. But you can learn more about Band Creek at bancreek.com. And also these guys are running two different ETFs, a US equity ETF and an international ETF. And that's bancreeketfs.com. So Eric, I want to start, we often don't do this, but I think your path to where you are today is just an interesting one. As I was looking at your background, I mean, I think, and you can kind of fill in the blanks or fill in the gaps here, talk through this, but like you started in the investment business, then I think you went more towards engineering. Then you kind of came back to the nonprofit, like prescription drug type of supply chain with 46 Brooklyn. And now you're at Band Creek in your current position. And so I just thought it would be maybe for the first minute or two, like talk about that path. And specifically, I mean, the 46 Brooklyn thing is interesting. And what kind of brought you into there? And then ultimately what brought you into Band Creek?
Yeah. So thanks for the question, Justin. I was just like any other guy coming out of high school in this society, climb the corporate ladder. That's what I was supposed to do. Right. So that's what I did. And I just didn't know if I wanted to do it on the corporate side or on the investment business side. And so I kind of dabbled in both, kind of just to breeze through that entire first phase of my career. I, have experience in railroad. I have experience like working for Morgan Stanley as an investment analyst. I worked at ExxonMobil, modeling out refineries, just did like a whole bunch of stuff. Eventually I had the opportunity to move my family to Ohio, which is a very important place for my wife. She has a lot of strong family roots here. And then what the catalyst for me going and starting 46 Brooklyn was really my mother. She was diagnosed with pancreatic cancer in 2016, and she had a very long, arduous battle with that, both physically and even more so mentally. For any of the listeners that have kind of had a parent or anyone that they know go through cancer, I mean, the mental part was very, very tough for her. And, it really had me kind of reflecting on what I wanted to do with my life. And like the whole climbing the corporate ladder thing just there wasn't happiness coming from that. And so I was like, you know what? I just happened to be in the pharmacy world at this point in time. And I was seeing behind the scenes and a lot of the problems with drug pricing. And I was just like, I just want to do something with this. And so 46 Brooklyn, 1946 is when my mom was born. Brooklyn is where she was born as well. It was the password to her computer at the time when we were going through all of her files and photos and everything after she passed. So I just kind of was like, you know what, I'm going to start this company. And the beauty of this country is like with almost no money, you can start a company, get a website. I was in business like after a day after filing everything. And initially I didn't know it should have been a nonprofit, but eventually the work that we were doing, it felt like it was housed better in a nonprofit. And I mean, it just took off. Like I didn't realize the appetite for information, even it was like super nerdy and long winded and everything. I mean, we didn't have the best delivery, but I mean, there was such a huge appetite for what is wrong with healthcare within this country. And we were filling that void. And so like very quickly we had, national media attention with our first, publication. I had, eventually people like Mark Cuban that were reaching out and starting to follow us. And, that's a whole nother story because like we kind of got involved in the very early stages of the cost plus drug stuff. And I mean, it was just kind of like this weird, like literally it's a movie, of what I was living through at that point in time. And maybe one day I'll write the book, but, so that was what 46 Brooklyn, I was inspired by, just wanting to do something different, something important with my life, when I formed that. And I was inspired to leave for the same reason, I mean, after kind of diagnosing and talking about the same problem over and over and over again, even though the company was doing really well and I had a for-profit as well by then, and that was doing very well. And so, success-wise, I was checking off the box, but, it was just kind of getting exhausting. But talking about the same thing over and over again. And at the same time, my best friend, Andrew Skadoff, who's the founder of Band Creek, he was working on this amazing investment thesis, which I really liked. It had to do with all the things that we'll talk about, information theory and Claude Shannon. I was just fascinated by it. And I thought back to like, why did I start 46 Brooklyn? I did it for freedom. I did it so I can enjoy my professional career. Thankfully I'm financially stable enough where I could afford to do it. And so I'm like, so I would be selling myself short if now I was trapped by it. And so instead I said, Andrew, let me get myself out of this business and then come over and work with you. And I've been doing that for 4 years now. So for over 4 years.
So that's great, by the way. That's a great story. Thank you for sharing that. I think if you were to describe information theory to just your average investor, how would you do that?
Yeah. So, I mean, it's the foundation. Now, to be very frank, like I'm a chemical engineer, but that doesn't mean I understand information theory that well. But the way that I would explain it to an average investor is it's basically like able to distill kind of signal from noise in some extraordinarily elegant way that was cooked up in Bell Labs that ultimately right now we are using to have this call, like it's all the foundational kind of math and principles that have ultimately enabled us to have a call like this. But there are spin outs of this that have been applied to just about everything that you probably know more than I do about it. But one of the areas was finance. And so John Kelly was a colleague, a younger colleague of Claude Shannon's at Bell Labs. And he at the time developed the Kelly formula because it's so interesting. Like all of these brilliant mathematicians loved figuring out how to invest and make money investing. It was like the ultimate kind of like test and game for them. And so they were doing it like on, probably not, fixed horse races and card counting. And like, Ed Thorpe did a lot of this kind of stuff too in the very early days when, he figured out how to kind of count cards and everything. Well, he was using the Kelly theory or the Kelly formula to figure out how much should he bet when the deck went in his favor based on like how many aces were showing and stuff like that. So that's how I would explain information theory is like, it's all the stuff that I certainly don't understand that is allowed for communication, the way modern communication. But there's this spin-off into the financial world that we are very directly using as the foundation for our ETF products. And ultimately it was the reason why I left 46 Brooklyn is because I was so excited about like, how do we actually figure out to take this elegant concept and use it to scale what the traditional analyst would do. Like if I only have a certain amount of capacity to study stocks and financial statements and everything, which is what I did in my past, like how do I do that for 1,000 stocks? Like, is there a way to 80/20 it as an engineer, you know? And I really do think that a lot of that lies in these kind of esoteric kind of mathematical formulas and information theory that we've been able to kind of dredge out and then really develop over many years now. I mean, this is not an easy or quick process, but I mean, I'm just grateful that we've made it far enough to where we can actually offer this engine to the public at very affordable ETFs.
Yeah, very nice. Let's look at, and we'll put this up on the screen. So if you're listening on audio, you might want to go over to YouTube because there is going to be some visuals here. But you have, let's step into one of your data visualizations and sort of what we can learn from this. And it's specifically, it's the Bancreek U.S. employment data tree map.
Yeah.
Where you're showing, changes in, you're using, I guess, U.S. employment data, and then you're showing changes over time in different areas of the employment map. So I'll let you just talk to this.
Yeah. So I was motivated to do this because, I did a lot of this at 46 Brooklyn. So if you go to that website, you will see dozens of data visualizations that are creating kind of a visceral experience of analyzing data. And data visualization is art, right? And I'm not really good at it. Like I'm still a novice when it comes to it, but it should be where you pull it up and it triggers that kind of creative side of your brain. And when you're looking at it, you just absorb the story rather than think about the story that much. So still working on getting there, but that's my intent. That's where I'm going. And so I did this a lot for drug pricing data, but drug pricing data is like off the beaten path. Like not a lot of people pay attention to it. I mean, it's really important, but it's very, very niche, right? So it made sense to me. And a lot of it's behind paywalls too. So it made sense to me why, you didn't have free public data visualizations that the public could consume to see what is spread pricing as an example. Like how are PBMs, pharmacy benefit managers, making money by charging different prices for the same drug to the client, the employer, and the pharmacy. Like we were able to show that kind of stuff and expose it with public data sets. So I come over to Band Creek, and sorry for the extended story, but I want to give some context here. I come over to Band Creek and I'm like, oh, this is employment data. This is inflation data. The whole world revolves around this data. Like it can literally move markets by trillions of dollars on one bad data point. Okay, so where's all the insight? Where is it? And so maybe some of it lives behind paywalls, but I could not find anything in the public domain where an investor, the general public, you don't have to have any money, you could just go to it and be like, what happened? Like, I want the story. And I don't want it from the media. I don't want it from the press because they're just going to tell me whatever their story is to get clicks, right? We know how this works. I want the actual story. I want a way for you to make it easier for me to analyze the data in this visceral manner. So I did that with inflation first, but we're talking about the labor data. This is the establishment data. So it's very important to note the distinction between the two. The BLS, and on Friday, it's going to come out September 5th. It publishes 2 data sets every Friday. It publishes the household survey data, which is where unemployment data comes from, or the unemployment rate. And then it publishes the establishment survey data, which is where, the non-farm payroll gains come from. So I'm looking at this and I explore databases. That's what I love doing. So I'm digging through the data and I'm like, oh my God, there are 500 different industries in here. Like you can go all the way down to sewing machine contractors or something like that, And so I'm like, it would be really cool if somebody could put together a heat map so we can see what was growing, look at it over different time periods. You can either use it as kind of a way to analyze that latest data point if you're just trading current data, or you could look at it and over the last 20 years, 10 years, if this is used in an educational setting, which I'm hoping one day it is. And we can be like, wow, look at the change in warehouse and storage as Amazon has basically dominated retail. Look at the decline in the big box retailers or the general retailers as Amazon is taking their business. Look at the boom in healthcare services, especially for elderly people. It tells you a lot about how the economy has changed and what is driving our economy, which has led me to probably to some of the concerns that we'll talk about a little bit later. But what you're seeing on that screen is you have to think of this as kind of like, it's a hierarchy, right? And it's called the NAICS hierarchy, NAICS. It's published by the census, right? And so if you go all the way on the top level, which is level 0, think of it as like an elevator that's going down. So level 0 is total non-farm payroll. Then you go down to level 1 and it gives you a little bit more of a drill down. You get all the way down to level 7 and it's like some really obscure industries, right? And so when you choose that display level, it will show you each one of those industries, and each region of the visualization will be kind of a box. So like that will be the overall super sector is what it's called. So all the healthcare stuff is grouped together. All the professional business services is grouped together. All the retail trade is grouped together. And then when in that, you're going to see the size of the box representing kind of like how many jobs were actually created, and also the color as well. So it's right away, when you look at each individual display level, it's showing you immediately what is driving the change over that chosen time period. You don't have to think at all. You just have to go and observe and play with it. And then when you actually go and hover over any one of them, it brings you to that historical context. So if you hover, you'll see the trend chart going all the way back to 1990 for every different, every industry. You'll also see some metrics around it. Just that's for kind of like the granular context around, so I understand that healthcare has grown by X amount over the last year, but what does it really look like over the last, like going back to 1990? So that's the way that I chose to design it. And I'm always looking for feedback. If there are tweaks that I can make or enhancements, please don't hesitate to reach out to me. But that's the way that it worked in my head.
Well, it works well. I love the tree map structure of this for that, because that downward moving elevator, I mean, it makes a lot of sense to me. And I think this is what we're going for. We want intuitive, because then intuitive leads to faster and more broader applications by whether you're an average investor or somebody way up on the ladder here. So one data point in particular that kind of blew my mind looking at this, because read this, I hear about this, I don't see it visually articulated the way you visually articulated. You found 63% of all private job growth over the last 2 years came from not sewing machine contractors, but healthcare and social assistance, which only represents 17% of the workforce. This is a staggering change in sort of like this maintenance economy and these jobs. What's that tell us about the underlying health of the economy and labor?
Yeah, and Matt, that number is actually a little dated. It's actually 66% now after.
Oh, thank you. I feel better.
So it's even worse. So I think, I mean, Justin, I'm really glad that you plugged my report that I'm about to put out tomorrow. I have spent the better part of a year trying to explain why this is happening. I mean, when you spend even just 15 minutes glancing at this, what you'll see is that, and you'll really see this in the report that I'm about to put out, is you'll see like a plateauing and actually decline in almost every single major industry except healthcare. In fact, like when we look at professional business services, like this is where all of like the legal, accounting, people that are working for tech companies, like all of like the white collar jobs, it is actually in decline right now. And it has never been in decline in the history of the data. And that data goes all the way back to the 1930s, outside of a recession. So this is the first time that we've ever seen a decline there. But this is all being plastered over by this growth in healthcare jobs. And so the point that I've been trying to make is that this is all well and good until it is not happening anymore. Then all of a sudden it's like, well, we were seeing this in the details. Like we have like this extreme concentration risk. Like the example that I'm using in this new report that I'm putting out is like, let's say we have an equal weighted portfolio of 12 stocks or 15 stocks, which I think there are like 15 different industries at the display level 2 or whatever, which is the highest level. Well, would you rather, from a risk perspective, have an equal amount of job growth or an equal amount of your portfolio in each one of those? Or would you rather have 66% of all of your money in just one? Well, I mean, anything could happen, even if it's NVIDIA or even if it's whatever it is, like you could think it's going to grow forever, but something could happen to an individual stock or an individual sector. And so I've just been flagging the risk. And in the meantime, while I'm flagging the risk, like you're seeing the risks multiply. We're seeing the ADP data, which is another private data source, which is actually pulling direct data feeds from ADP clients. That is showing that healthcare jobs are actually in pretty substantial decline right now. You're seeing, really ever since the end of last year, the assassination of Brian Thompson from United Health, the sentiment towards healthcare has really turned. And I think it's put a lot of pressure on the companies that were kind of using this structural arbitrage, which we may or may not talk about, but I'm writing about it right now, which you can read my latest report on this, that has really driven a lot of the job growth. It was really kind of like a cash machine that these guys go to. And that may soon, maybe not coming to an end, but I'm not sure if profits can keep going up every year from that, given the ire towards the healthcare space. And then you have Medicaid, which it's like, look, I mean, let's just boil this down. I'm going to cut 10% of your podcast budget. Are you going to go hire a ton of people? Come on. I think that the argument that healthcare always grows, it's done this for the last 30 to 40 years. It's just lazy. 30 to 40 years is a blink of an eye, not for us in our lives, but in general, long-term cycles, especially with things that are structurally growing and contracting. This is going to come to an end. And we've never faced this magnitude of a cut in the second largest payer for healthcare services within this country. So there are a lot of warning signs there right now, and nothing else is stepping up to take the mantle from healthcare. And I can't come up with anything that is. In fact, when you look at AI, that should only create more problems for professional business services, for a lot of the areas where we would have been adding people. And so something's going to have to come completely out of left field to save us at this point in time. And I can't see it.
All right. So things we can see, besides AI being Allen Iverson in my heart only, not artificial intelligence. The only things I can't see, structural versus cyclical. I know you go deep into this in the paper. I want to at least touch on this because I think this is really important in what you just said about the structural arbitrage that they've been playing in the labor markets around the healthcare industry. Define those terms as you see them and why this matters so much.
Yeah. So healthcare at its core in this country, and this is why people are so upset with it, is all about price discrimination. It is textbook price discrimination, except it's not the good kind. The example I give in the report is when you go to Costco and they try to sell you the executive membership. I can tell you, I have 3 kids. Get the executive membership. It saves a ton of money. That's great, but that's price discrimination. I am going in and I am paying more to be a Costco member than someone else may choose to pay, but I am getting the benefits in return. That's great. The price discrimination that we see in healthcare is largely hidden markups to largely hidden artificially inflated list prices to the tune of where they're on average for generic drugs. So these are the off-patent drugs, 12 times the cost. This is the average. This is not this includes the ones that are 1,000 times higher and everything. And then completely hidden rebates and discounts that are flushed through this kind of litany of middlemen who all pickle away at them before it makes it back to the employer, who doesn't even tell the employees that they're actually getting a rebate on the $5,000 drug that you bought that really only cost $10. So that's healthcare. And it works like that for drugs. And I know this almost better than anyone because I have the battle scars to prove it. You can read it on 46 Brooklyn. But it also, this concept applies to health, to hospitals. It applies to just about everything. And it's because the intermediaries are sitting in between, hiding all of the information so we don't have a transparent marketplace. And that's what people are ultimately really upset about. Look, when I was 15 years old, so it's dating me, but 30 years ago, this wasn't a thing, right? Because we all had cheap health insurance with no deductible. And so make all the prices artificial and get rebates. Don't care. I'm not subjected to it. As long as I am not paying anything for my insurance and I'm not paying a deductible. Now all of a sudden, I don't know, what's an average deductible? People probably have $10,000 deductibles that are listening to this. Well, now you are subjected to these artificially inflated list prices that, Trump has made known accurately are vastly higher than any other nation that's out there. They're real prices, even though they started out as completely made up prices to just kind of do this price discrimination, right? So this has gone so far. And it's the reason why the Uniteds and the Cignas and, they've all vertically integrated to kind of hide, where the profit is being taken. And they could really almost dial in their profits because of this mechanism that nobody really was able. I mean, all of this is protected by contracts. So good luck figuring out any of it because all the clients are put in contracts with non-disclosures. So it's been just a really hard nut to crack, but I think it's finally cracking is my point.
Well, it's finally cracking because of work like this and because you're not playing the arbitrage of treating that Costco hot dog as a prescription drug. A different form of arbitrage, though.
I don't know how they do that for $1.50, including a drink. It's crazy.
Well, see, that could be your next data tree. You can do this on. All right. Looking at that sector specifically, because I think this is so interesting in the way you present it too, you've described it both as an economic stabilizer and for its potential risk. I think that's some of the sizing thing, but I want you to go a little bit deeper into that if you could.
So if you look back on prior recessions, it has grown through all of back to where I have the data, which is 1990. And so had it been more economically sensitive, had there not been this arbitrage, had our demographics been different and the demographic trends been different, then theoretically, like it would have similar cyclical behavior as like another, service industry or something like that, or product industry when it comes to drugs, but it has not. And so given that we've had all of these things in play and getting worse and worse and worse, it just continues to grow, which is basically acted as a stabilizer in 2008. As bad as 2008 was, it could have been far worse if we didn't have all of these things that we don't like about healthcare, right? They just weren't as bad then because it hadn't the bad stuff that's going on compounded over time and it just got bigger and bigger and bigger and bigger and bigger. So that argues for, like, if we're about to head into recession, I'm not saying that we're going to, it could be a pretty big stabilizer right now, but you would have to lean further into making it okay for all of the inequity issues and the price discrimination, like all that stuff would have to be like, it's okay. Just keep doing what you're doing. The status quo is okay. And then it should be a buffer against the severity of a recession. But if we flip it, and if all of a sudden we're like not willing to stand for this, which trust me, like there's a very big part of me. I spent years of my life trying to fight this, but now I'm on the opposite side of this, looking at the economy broadly, being like, we got to be very careful how we fight this. Like there are very targeted policies that you could enact that nobody would understand. And so therefore you can't have a politician sell it to get votes. But those could work over very long periods of time, right? Slowly moving this in the right direction. But the broad brush, like chop 10% of Medicaid and most favored nation and all these things, they are basically just like taking a sawed-off shotgun to the head of healthcare jobs. And I mean, it's just, to me, like it could, all the benefits that we've gotten from it be acting as a buffer in prior recessions, it could be an accelerator of the recession this time. Not saying it's going to be controversial saying this, because it's never happened in our lifetime, right? So people are going to be like, well, I haven't lived through it. But I mean, I'm telling you, like it's lining up for that to happen and it would be unprecedented, but we should at least be aware of the risk as investors.
I think it's a fascinating perspective to look at this as a form of a stabilizer because it's an extension of that social safety net idea.
Yeah.
To see it this way, which is so interesting, both as an accelerant and a downturn, but then also without the downturn. You wrote too about the sort of like the impact that Medicaid cuts could have and how significant just Medicaid alone could be for employment and the economy writ large. Explain that.
Well, so one example that I posted about on socials, and I'm going to actually include that in the next report so you don't have to go digging through my posts, is the fastest growing, and this could be a trivia question that no one will get right besides stuff that people that read us. The fastest growing kind of granular industry. So remember we talked about the hierarchy, the levels of the elevator. If you go down to level 6, over the last 20 years, the fastest growing industry is services for the elderly and disabled persons. That's it. And so when you actually go, and you can actually go to the census.gov website and you can look at what is this, it turns out that it is daycare centers for disabled people and elderly people. So if you have a parent who is not is with it enough to be able to sleep in their own home, to live in their own home, to have the safety, the security, the familiarity of their own home, but they just need help during the day. And Matt, you work a job during the day, so you can't just quit your job and then go take care of them. So you could drop them off at a daycare center, which by the way, are everywhere when you start looking. And it's vastly cheaper, more affordable, gives them ability to socialize, someone looking over their medications, managing their medications so they're not taking too many or they're taking them at the right time. It saves money. But when you actually go and you look at who is paying for this, it's like the vast majority of the funds come from Medicaid. And it's a waiver program, which means that it is optional. Like it is the first thing. Like if the states are looking at it and they're like, okay, we got to cut something here because the money's going away, they're going to cut the waivers. And so there are over 4 million people that are taking advantage of this right now, and almost 2 million people working in this industry right now. And that industry is at risk in my mind. I mean, the demographics, the way that the demographics look, and this is the pushback that I get, industry could grow literally forever. I mean, through 2100, it could grow because of how much we're aging, which also makes you more worried about immigration, which I'm sure we'll talk about. But I mean, if you start pulling the funding from it, what's going to happen? I also ultimately, I rely on Jerry Maguire, the show me the money quote. I like following the money. If you follow the money when you're doing studies of supply chains, you tend to end up with the right answer, at the end of the day. And if the money is going away and this is the easiest thing to cancel, this is a lot of jobs and a huge human toll as well. And in reality, what's going to happen is these people will probably just get institutionalized and end up costing Medicaid even more. Or what will happen is, Matt, you'll quit your job to go take care of your parents, and then we'll have unemployment that way. So the fallout is so complex, but that's just one example of how it could be hit. Then the work requirements as well. I mean, the way that those are implemented is potentially pretty dangerous as well. I mean, there's just one after the next of different ways when you actually look through. There's so many ways that they're actually cutting that, any impediments to really the healthcare system working and the second largest payer working the way that it works right now. You can argue about work requirements all you want from an ideological standpoint, but I can tell you if they're put in place, we're going to have less jobs. It's just kind of a high likelihood that we're going to have less jobs if they're put in place.
So this one hits me particularly hard, both on just the data level, but also on the personal level. I have grandparents who are beneficiaries of these systems existing. I have family members who are beneficiaries of these existing to help care for family members. I have a spouse who's worked in and out of nursing homes over the years too. These are not high-paying, glorious jobs, but they're a huge part of what's going on, what matters. And you walk into one of these places, immigration reform is going to have an impact no matter where in the country you are.
Yeah.
This new report, you're pulling back some of these numbers. Explain what you're finding in healthcare and immigration policy and why this is all so connected.
Yeah. So, I don't know why more people aren't talking about this, but now that I'm actually out there looking, it's if you see one beetle and you're looking for it, then you see all the beetles. Now that I'm actually when you're driving with punch buggy or whatever, when I'm out there looking for it, I just saw the chief strategist at JP Morgan, he's talking about the exact same thing now. There are pockets of the market that are starting to talk about the issues, very long-term issues on labor supply with what's going on with immigration. So what I did was I looked at that other labor database, the household survey data. And when you drill down into that data, there's actually a feature within that data that's called the born status. And so that's either native born, so that's US born, or foreign born, i.e. immigrants, right? So I'm okay, well, I'm just going to look at this and actually I had about 18 and a half years of data in there back to the beginning of 2007. So I'm going to look at this and I'm just going to try to understand what happened, what would have happened had we done this in January 2007. If we would just basically shut our borders and then started actively deporting people, what would happen back then? Well, it turns out that the story is even deeper. I got more than I bargained for, because when I started looking through it, I also looked at another dimension, which was the age group. So, 16 to 24, 24 to 35, 36, so on and so forth, and 65 plus. Well, it turns out when you look at the native born population, it has only grown by 0.7% CAGR over that 18 and a half year period. And the largest source of growth, The cumulative growth of the 65 plus has been 63%. No other group has been more than like 20%. And in fact, like the 45 to 54-year-olds, which by the way have the highest labor force participation, has shrunk. And so you look at it, and we all talk about how the labor force participation rate has dropped post-COVID, and people were like, why has it happened? Is it COVID? People aren't going back to work. All wrong. The data doesn't prove that at all. So what it is when you actually look at the overall, it went from like 65% to like 62 and change for native born. But if you strip out the 65 plus group, the 64 and younger down to 16 years old, that went from 75.2% to 75.3% for US born. So we actually have a higher workforce participation rate right now. The problem is we have a weighted average problem. If you've ever done a weighted average calculation, which I know this is as complex as information theory, but this is where my mind goes. If you ever done that, if you have like the low participation rate group, which by the way, the 65 plus participation rate in the labor force is 18%. These people are retired. They deserve to be retired, right? So unless we rethink that and get these people to start all working, that's where all the growth in the US born population is coming from. It's coming from the 65 plus. In fact, when you look at the census data, they forecast all the way through 2100. This is the same government that's basically kicking immigrants out. They forecast that the 64 and younger native born is going to decline. It's going to be lower in 2100 than it is now. Whereas they're going to be 30 million more 65 years and older. And so this is huge downward pressure on the labor supply for native born. And all told, if you look at the 18 and a half years that I looked at, out of like 128 million people base within that initial kind of native born group, we added 11 million jobs. It's not that many over 18 and a half years, right? Immigrants or foreign born, the base was like 23 million. They added almost 9 million jobs. So we would have been short 9 million jobs today had we basically shut the border. And that's not even saying like kicking people out of the country. That's basically just saying no new immigrants, nobody can work. And that doesn't even get into something which I'm not talking about in this report, which is like labor is not fungible, right? So like for people that are listening to this in New York, like go in and like observe who is serving you. Like when you go to a Chipotle or a Starbucks or whatever, or who is cleaning the hotel room. Like these are people that are actually willing to take a train in for an hour from a place where they can actually make ends meet to make not just enough money and then take a train back. Like these are hard-working immigrants that are willing to serve you. Well, guess what? If those people are kicked out of the country, we're going to have to call a bunch of people from Kansas and then ship them over and say, you work those cheap jobs. Because the people in New York that are living in New York City are not going to do it. And so either that or all those employers are going to have to pay a lot more money to get native born people who are living in the city or Brooklyn or whatever to go do that. This is how you create structural inflation. It's so much more complex than just looking at it. And that's the reason why I kind of can drone on this forever, because we're sold a story of like, I see that one person took my job. But guess what? If we eliminate that whole thing because you're upset about that one person, wait to see what happens to your retirement account.
Perfect segue. Without being long-winded, without me getting stuck that instead of Jerry Maguire, I only want to think about Happy Gilmore and his mom in the nursing home, which might be a better metaphor in some ways than Show Me the Money. I want to go to the CPI visualization tool because it's indirectly connected to the point you just made, but it's powerful. So we'll throw the chart up on the screen here. What's the most important thing? What do you see driving inflation in this recent past? Tell us that story.
Yeah. So I was like a broken record with this for months and months and months and months. I was like, inflation is just three things, right? It's shelter. So it's OER, it's rents, it's the big bubbles. Like, I mean, this is the reason why I created that. And I was so excited about this visualization is because like, listen, all you have to do is be able to distinguish big bubbles from small bubbles. If you can do that, you know what drove inflation more than anyone else, because what I'm actually doing here is I'm calculating a weighted inflation for you. So these are not the overall, like airline fares went up by 15%. Like, no, you have to apply the weight within CPI. And so like eggs can go up all they want. Let's be honest, they don't matter. The weight is so small. So like eggs get all the headlines because they went up by 55%. But if the weight is like 0.05% or whatever, multiply those two together, and it's like, that is not a driver.
It's your micro cap or your small cap stock, like not even
Exactly.
mattering on a
Yeah.
half of a bad day for NVIDIA.
Yeah, that's exactly it. So I'm glad you I'm glad you brought that up, because that's the best way to kind of tell an investor what's going on. So OER is the NVIDIA of CPI. Like, owner's equivalent rents of residences, which is basically, for those that don't know, it is basically the proxy for what are rentals, what is the rental rate or rental inflation for people that actually own their homes. And it's based on a survey. They call people up and they're like, what could you rent your house for if you hypothetically were going to rent it for? And they go on Zillow and I don't know what they do, but they come up with a number. And then that's like the accumulation of all the survey results. So that had been what is driving that for a while. This last month, what was interesting is we started to see healthcare inflation, which it's a little early, right? I mean, this was only one data point. It could be an errant data point, but healthcare has a very big weight, especially with PCE. So, for those that don't know, I have two visualizations out there. I have CPI and I have PCE. PCE is overall expenditures, whereas CPI is supposed to be just the consumer expenditures. PCE is the one that the Fed says that they pay more attention to, especially core. When you look at the weight of healthcare, because of everything we just talked about, there are all sorts of other payers like Medicaid, Medicare, employers. So healthcare is a huge weight within PCE, whereas a smaller weight for the consumer within CPI. If healthcare inflation starts to rear its head, this is very bad, and it's starting. I mean, so I'm keeping an eye on that, but I'm hopefully optimistic that this is just an errant data point and it's going to go back to where it was, whatever. Everybody says they're seeing a lot of this tariff stuff flowing through. I'm just not seeing it yet. I mean, I have no edge versus anyone else that knows how to use my visualizations. Go through and look at like the big red dots or the small red dots. And yes, you will see audio equipment really spiked. Okay, that's probably one of them. But again, it's so small, I don't really see anything meaningful. And I'm not sure when we will. To me, I care more about the big circles. And those are always the ones to pay attention to, because as soon as the big circles start moving, like gasoline as an example. I know it's not core, but gasoline is a big circle because it is a big weight and is highly volatile. And we know in the second half of this year, as long as gasoline prices remain relatively stable, don't go down a lot, we are going to swing from very large gasoline deflation a couple months ago to meaningful gasoline inflation, which alone will probably push us above 3%, like well above 3%. If we get anything above that, we're just not going to have the right trend on headline. And that's I write about this all the time. Like, this is just math, right? It's math and you looking at the pump, waiting to see like a 40-cent drop per gallon. As soon as you see that, you're like, great, okay, we'll be all right. But if you don't see that and it's stable, the number's going to go up. It's pretty much that simple, because there aren't a lot of combinations of high volatility and high weight. Those are the ones I really pay attention to. Airline fares gets into that a little bit. There are a couple others. Motor vehicle insurance gets into that. Used car prices, new vehicle prices. Like, these are the heavy hitters that if they start really kind of going a little haywire, they'll move inflation pretty fast on a month-to-month basis.
We're going to talk about your investment process here, but I'm just curious, on all those things we just talked about, does any of that inform any part of the investment process, or is this just kind of research that's very interesting, but it doesn't necessarily get incorporated into the process? How does that work?
I'd say it informs the process indirectly. Okay. So the way the process works, and I'll let you ask the question, but Anton Yen, who's our chief data scientist, he is constantly iterating. And it's based ultimately on a set of features, right? So it's a model with a set of features. And based on the work that I am doing, we are constantly evaluating new features. There could be macro features. There could be individual company specific features. There could be quantitative features. We are looking for ways to ultimately, like, we are not going and vetoing the entire process and saying, Eric's terrified about the future, let's throw this all out. Because at the end of the day, like, they're two separate things, mostly, right? I want to be of service to people that are going to use this to make decisions on their own, right? Like, our ETFs may not be for everybody. Like, there could be macro traders, commodity traders that are going to get a tremendous amount of value from the work that I'm giving them, but they don't care about US equity ETFs. But then there could be people that are interested in that, but then also are always going to have US equity exposure. Like, think about it. If you're an RAA, like, you're going to have US equity exposure. And if we can provide you with a differentiated version of that, where we're at least keeping our eye on ways to tweak this around the fringes, like, I mean, we're still US equities. And if ultimately you kind of read my report and you're like, oh boy, I want to get out of this, you're probably not going to want to buy because, but you may want to, if you have to have US exposure, you may want to shift some to because away from the spies or something like that, because we are leaning more towards into quality businesses, more towards resilience, less towards a lot of like where the flows are going and stuff like that, which is what our tools are ultimately designed to do. So I don't know if I answered your question, but like it's in the very long term, I think the two are connected, but in the short term, they're less connected.
Yeah, no, that makes sense. And by the way, because is the ticker symbol BCUS
Yeah,
of the
that's the
of one
US
of your
one.
ETFs. I think your US equity ETF, right? Yeah.
Yeah. And international is BCIL. Yeah.
Yeah. And when I think the way you responded to that is right, because I mean, you may have a bottoms up systematic approach, which I want to ask you about, but ultimately, if you have these massive trends, it's like, you think of like the tide going out, like the famous Warren Buffett quote, you know who's swimming naked or has too much debt when the tide goes out. And it's kind of like that. Like, you know what I mean? These trends are obviously going to influence the underlying fundamentals of all companies or many companies in the market. And so sort of where those two things meet, I think is important over time.
Yeah.
So talk about, how would you explain how information theory actually is applied to systematic investing? And specifically, I think, the quote that you guys have is your approach is like this, the smartwatch for stocks.
Yeah.
I like that.
Yeah. When you go back to information theory, like we are using this one slice called the Kelly criterion or the Kelly formula, which really boils down to edge over odds. So there's a whole bunch of math behind it, especially the way that Anton has had to build this in so we can do it so rapidly and over billions of model iterations and everything. But it boils down to edge over odds of any individual game of risk, which you can include in equity as part of it, right? And so we are using an iteration or a variation of the concept of the Kelly criterion. And Andrew's kind of innovation that led me to run from 46 Brooklyn towards him was figuring out, like, how do I take this and apply it to screening equities? And it's been a work in progress building that over time until we finally got to the ETFs and were able to kind of automate the entire thing. So Anton is using these concepts and then putting that into amongst many other variables, right? So like Kelly or our version of Kelly, because it's not like, the information theory purists are going to call me out on it. It's not like pure Kelly. The concepts of it don't work directly. We've tested many times. Like you have to have, like, the way I like saying it is like, if you're going to prepare like a great steak, like it's going to be okay if you just, but like you have to have like the right temperature that you're cooking it at and the right seasoning and like all that kind of stuff for it. And so everything else is sprinkled in. And this has been the process of like, what other features do have that signal, going back to the core of information theory? What other features have signal over noise in choosing businesses that we think have what we call systematic endurance? And the whole concept of endurance, like I'm a runner. I love running long distances. I have my smartwatch on right now, my Garmin, right? And so this Garmin will tell me what my VO2 max is at any given point in time. Your Apple Watch will do the same, pretty much all of them. And it's estimating that. The VO2 max is basically one of the best kind of measures of long-term endurance. And it's a single number, right? The best way to get that VO2 max is to go into a stress test, right? It's very painful. It's costly. It takes a lot of time. And so the way I look at like the stress test for equities is what a deep fundamental analysis would be. I'm going to go into all my 10Ks. I'm going to go into the 10Qs. I'm going to read all the calls. I'm going to do all the stuff that I've done in the past, right? That's the stress test to really find out, does this business have endurance? Does it have longevity? What we figured out is we can 80-20 that with using Kelly plus all the other features that we've kind of combined in this model by using effectively what a smartwatch is doing. So my heart rate is kind of like the stock price. And so there are a lot of signals beyond just the stock price that are embedded within the stock price. Lots of stuff. And so you can actually feed a lot of the historic stock price, the volatility, all this information through these complex formulas that we're using to, at the end of the day, come up with a VO2 max for stocks, which is like the Kelly criterion. You combine that with all the other things that we have, and we can rank all stocks in an entire investable universe, literally in minutes. And so I can basically ask Anton, I can call Anton up and be like, rerun the tool right now. And he'll rerun it. And then there will be like 2,000 stocks that are investable, that have the right market cap and trading volume and everything, because we're a large cap. We want to have very, very high primary liquidity, right, with these ETFs. So I'll call him up, he'll do that, and then he'll output, boom, here's the list. Highest endurance to lowest endurance, literally 1 through 2,000, And then based on the new data that comes in, the list changes. And so at any given point in time, we're just choosing the top 30. And then you may ask this question, but we are, at the end of the day, the buck stops with us, right? So this is only as good as the historical data is. I believe historical data is wonderful in assessing, especially if you're using enough of it long-term, you're looking at it the right way. Because if you are looking at a company that has very long-term EBITDA, right? Just let's say EBITDA growth, they're probably doing something right. You may not know what, but when you start studying it, you're like, oh, wait, they have the right LTIP program. They're incentivizing people correctly. They have like a competitive mode. They have a great leadership team. They have a good bench. Like there are all these features that qualitatively give them endurance within that company. And that leads to an output that is sustainable EBITDA growth over a very long period of time. Well, the stock price follows EBITDA growth over a very long period of time. So we're like reverse engineering, looking at for stock price signals, data signals, that is pointing us back with a high probability that we're going all the way back to the underlying fundamentals of that company, if that makes sense. We're not going to always be right. This is just data, right? And so we have the two things that help us with that. There's the human overlay. So for example, after you read my piece on healthcare, you'll be like, you probably don't own a lot of healthcare. And you'd be right about that, because I don't think the historical data has any bearing on where we're going in the future. So I have come in and said, look, I don't want to own the healthcare companies because the whole world is shifting. Can't trust the historical data anymore. And then the other thing that we have is the whole recycling of it. So every 30 days, every like month, we're rebalancing and we're recycling and we're taking the new top 30. And if there have been any shocks to any of them, it's going to flag something. It's almost like a stop loss to kind of say, the model's like, I'm not so sure that the endurance is here. I think it is. I mean, it's still number 50 company, but it's not the top 30 anymore. My conviction is wavering versus like number 2. And so what we do is we're like, great, whatever, let's get rid of it. And we just kick it out. And then a new stock comes in that's number 30 at that point in time. And that way, like, if we're wrong, we're not going to sit around like, this is the problem with being like a deep value fundamental analyst, is you get so attached, right? We're human beings. We get attached to companies that we love. And then you just ride the damn thing down when the business changes. And by the time like it's 50% lower, you're like, wait, what happens? Well, now I can't sell it. We don't worry about that. The model does that for us. So there's no human emotion in it, which for me, that's always been my flaw as an investor, is being too human. And so I love eliminating that part of my own kind of emotional biases within the tool.
Well, as a runner, also, I love the VO2 max sort of like analogy with the stock selection, the types of stock, the qualities that you want them to have. But I guess it kind of to sum it up, and this is a question, but it sounds like it's things like earnings quality, earnings consistency, probably healthy balance sheets, not a lot of debt, and that and the earnings aspect would imply like a moat around the business.
Yeah.
Things like, so it's kind of like quality. And is there any valuation? Is there any valuation ratios that come in?
Yes. So
Okay.
we have done, valuation is like the most highly debated topic between the investment team, because we were all taught that cheap is better. But in reality, if you're a deep value investor, I kind of think you're like a VC investor, because when the market is signaling that something is like 9 times earnings, it probably has sense there's something very wrong with this business. And you're really not buying it for 9 times earnings. You may be buying it for 30. And so, then it just keeps going down and down and down. Every now and again, you'll hit a home run because the market was wrong. That's not what we're trying to get involved. So low value is not better. High value is not worse. But there are many examples where a business will re-rate as well. So very high value is dangerous too. And so what we've found is like there's this sweet spot that generally you want to be in order to also kind of focus yourself in these higher endurance businesses that are like less sexy, like less kind of trendy flow businesses and stuff like that. The multiples have likely settled around certain places. And then until the business gets disrupted, they'll go back and forth with cycles and with market sentiment and everything. But generally they kind of have like established that they deserve that multiple. And some businesses are structurally far higher and some businesses are structurally far lower. And we're looking for kind of those businesses that have like the market has come to an agreement on what the business is worth, rather than it being around a transition or like completely harebrained unknown around like, extreme earnings growth expectations like you have with the NVIDIAs of the world and stuff like that right now, where we just don't know if like growth like that can kind of persist and if the multiples are even accurate. So valuation is very important. We have spent the most time studying valuation. Do we include it as a feature? Do we include it as just basically kind of bumper rails, like guardrails, like if you're going bowling so you don't get a gutter? We've done all of them and we've settled on kind of a sweet spot between them, but we are constantly iterating to try to figure out like what is the best way to use valuation when it is not as black and white as we are taught in business school.
I'm not looking for like specific names in the portfolio because investors can see those at any time because ETFs always have to report those, on a daily basis. So if you're interested in what's in these strategies or portfolios or ETFs, you can go look. But is there any interesting patterns in terms of sector exposures or industry exposures that sort of this model is picking up, both on the US and international side?
Yeah. I mean, on international, interestingly, if you go and you look at that, it is so different from what you would expect because like we are US based investors. And so US, you're going to see we're heavy industrials. And that's because industrials is kind of like, it's actually like a catch-all. There are some IT businesses in there. There are more retail-y businesses in there. It becomes a catch-all for a lot of businesses that actually have all of those features that we're talking about. There are, we definitely have exposure to technology. We don't have as much exposure to healthcare as we talked about. But industrial is kind of like the one kind of theme that I think that you'll see that the model really, really tends to lean towards. International is totally different. Like when you go over to Australia, model loves like companies like, retailers that would not even be in business here anymore, like, or be dying off and killed off from Amazon. Those are great in Australia. Like I'm not going to throw out any names, but like you can look at it, but it is also because like I want to condition people to understanding that we don't have attachment to names, right? So the name could be in there now and it may not be in there a couple months from now because we rely on the process. But it is really, really interesting to see the different types of business models that we would think are not high quality business models here in the US actually are very high quality business models internationally. And the exposure is like so different from like the collection is so, you would think it is so random. There is nothing holding all these together besides that I can tell you that, the people at Bell Labs would have loved all these companies. But that's the only thing holding them together is that they all screen very highly when we use these algorithms that we have. But it's a very strange combination, strange and beautiful.
So we have two standard closing questions. I'm going to ask one and then I'm going to let Matt sort of close us out here.
Yeah.
But the first one is, what's the one thing you believe about investing that you think most of your peers would disagree with you on?
Yeah, I love this question. So, and this is going to also be controversial, but that no one can reliably do it. I think that I am a student, I always have been, of cognitive biases. And unless you are like the Dalai Lama, but if you've gotten to that point, you probably don't care about investing, but then you've conquered all of your emotions. I think it is very, very, very difficult for anyone to overcome their biases, to repeatedly pick stocks and then not have attachment to their ideas, get out of them. There are a handful of people that have done it for sure, right? But not enough to where I have seen that there's anyone that has any particular edge in this, which is the reason why I love, an algorithmic approach to this. Like I love entrusting this to data, even though it's not going to be perfect, it is overcoming all of these biases because our algorithms do not care about that. They just want to learn and get better. That is all that they're trained to do. And that is our entire focus. And so I think they're, like look at Renaissance, like how have they put out the results that they did for as long as they did? Models. So, I mean, I think that we're embracing models within everything else that we've done. We don't think anymore because we just ask AI to solve all our problems. Like, I think that we're late to the game in investing, and like a more model-based approach where you really understand what people are doing, because you don't want it to just be like, throwing a bunch of spaghetti against the wall with, no causation and all correlation. Right. But if you really talk to us and understand what we're doing, I mean, I think this is the right approach, because my view on investing is that nobody really can reliably do it well.
Well, if no one can do it well, and based on all that experience and the great Kahneman lesson, I mean, at the end of Thinking Fast and Slow, even he says, you might be a little bit less of a horrible person around the water cooler after these 600 pages or whatever. That's the best I can offer you. Yeah. It might be a little bit less unsufferable. So what's the one lesson you, Eric, would teach the average investor?
That's very clear to me. Anything can happen. I could be wrong about anything, but I think, especially in these times where it didn't used to be this way, but we are so distracted by the shiny this or that, or like the political situation polarizing everything, that there are crystal balls living in data sets right now. And so I think the most important thing, if you want to actually be a great investor, a smart investor, is to learn how to do what I'm doing. Like, I get it. Some people are just not going to trust me. You're going to think that I'm making money. I'm not. Like, I'm telling you that there's a lot of problems going on, and we have, because, which is our US ETF. Like, this is working against me, if anything, right? So, but I mean, I think like the most powerful thing that I've ever done, and the way that I have done so much in a relatively short career, is I've always learned through data. Data has ways of basically accelerating the learning curve if you know how to ask questions from it appropriately, to where I feel like you can learn 5 to 10 years of information in months. And so it's like drinking from a fire hose in the most powerful way. And I think people have given up on that. Like, there are very few people I should not have been able to come in here in 2024 and create data visualizations on the two most important macro data sets, and they have not existed before. Like, that should not have been a thing. But I think we've just lost focus on what really matters. And so if you want to be a good investor, or you just want to be good at life in general, you want to have a great professional career, don't just trust what other people are telling you. Study the data yourself. Tools like Tableau have made it so damn easy. You don't need to know how to code anymore. I mean, you can even ask AI to do a lot of this stuff for you. So that's what my one recommendation would be.
Absolutely love that. If people want to find more, they want to read these papers, they want to play with the tools, where should they both find you and this information on the internet these days?
Yeah, so everything is at bancreek.com. We'd really appreciate if you go to the website, if you sign up for a distribution list that really supports us. If you're there, there are links over to bancreeketfs.com if you want to get more information on these ETFs if they're of interest to you. I am somewhat active on socials. It's just at Eric Pachman on X, and then also Eric Pachman on LinkedIn. I haven't figured out how to use Instagram yet, but one day maybe I will. And so follow me there. I like posting this there because I feel like that's kind of where I can get it out the fastest. Although it weighs on me a bit because it's pretty toxic. I'm doing my best. But those are all the places that you can find us. But most powerful is really just going to the website and getting it straight from there.
Well, we want to thank you for your time today. This has been enormously useful. Cannot wait for that paper to be out in the world so people can see what we were talking so much about today. If you're watching Excess Returns, subscribe, all the things below. Eric Pachman, thanks for joining us.
Yeah, thanks, guys.
Thanks, Eric.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.